and overall indebtedness, and through that the policy instruments and sovereignty. I'm going to grab the mic here for a second and just ask a couple of questions on a narrow picture. Now, Governor Bollard and the Reserve Bank have pointed out publicly, and much of it's on their website, and they presented to the Finance and Expenditure Committee, much of the same analysis that you presented in your presentation, and specifically about the non-pass-through 575 total cuts, 450 to households, 230 to businesses and farms. The question which they sought to answer was, is the gap explained by increases in funding and borrowing costs and spreads and other issues? And the conclusion that the Reserve Bank came to was, arguably in the case of medium and long-term loans and mortgages, yes, but in the case of short-term variable loans and mortgages, particularly to the business and farming sector, no. So the Reserve Bank's view is taking aboard all of the data, which source data they agree with that you presented. They still cannot explain the gap at the short end. So I put that challenge to you. Do you agree with Governor Bollard about the short-end loans? And can you share with the committee, and perhaps later with our advisors, any views on the, if you like, the weighted cost of wholesale funds to the banks that aggregates together some of those individual issues, wholesale funding costs up 100 basis points, local funding costs up 150. But of course, I'm sorry I'm elaborating here, but the share of offshore funding peaked in January at, I think, about 29%, and it's come off since then, so they're not facing quite the same costs now. And yet there's been no reduction in short-term interest rates since the start of the year. So, summing that up, do you agree or disagree with the Governor of the Reserve Bank that the short-end loan spreads are still unexplainably wide and at historically high levels? And secondly, can you give us any data on the weighted cost of wholesale funding in support of that?
I do agree with the Reserve Bank. The banks are effectively subsidising a low 2-year, 3-year fixed mortgage rate by having a high variable rate.
So, sorry, just to pick up on that, why would they be doing that if the issues for the economy about perhaps overexposure to property lending are severe?
Because their job is to lend and to make money, and the safest way for them to do that is to lend into the housing market.
That's right. It was, of course, a rhetorical question.
Sorry.
Weighted average cost of funds.
Yes, the weighted average cost of funds is that data is not available, and I think it's irrelevant anyway, because the banks have a pot of funding, and then they do a pot of lending, and how they allocate their maturity matching and their marketing strategies is for them, unless they want to disclose it to the Reserve Bank. I don't think it matters that much, because New Zealanders borrow mostly in fixed rate mortgages, and because interest rates have stopped falling, most people are going to go for a fixed rate mortgage.
But if we pick up for a moment on the back half of your presentation, which is that the tradable sector's been getting it in the neck because of this cross-subsidy while the housing market looks like it's off on another roller coaster, is it not therefore of interest that those short-term variable loans, which are probably overweighted in the business sector, especially at the moment, are too expensive? Could you attempt to quantify how many billions or millions, hundreds of millions of dollars of book value is tied up in that excessive spread at the short end? Now, Federated Farmers, for example, who are presenting later, say for farmers they think it's in the order of 300 to 400 million on the basis of 75 basis points. Any sense to the business sector, farmers, households?
I'd be making a speculative guess. My gut feel is there's about 50 to 100 basis points of cross-subsidy between business and housing that's in there.
Right.
But
and how many hundred of million would that?
450 million, 1% reduction.
That's for farming only.
Yeah. My view, though, is that interest rates for farming are too low. They need to be raised because the risk in farming is of a debt blowout. There is a credit risk in farming, which the Reserve Bank has identified, and that, frankly, the biggest scandal, if you like, in banking in New Zealand in the last 9 months has not been how much or how little has been passed on to fixed mortgage rates. The scandals that banks have lent an extra $3 billion to the farming sector.
Yep.
When the farmers are not buying each other's farms, because they've stopped buying farms, and they're not building new sheds and races, they're not investing, that is pure overdraft expansion on losses.
Well, that's something we'll be asking Federated Farmers later. But my final question before I hand over to colleagues, on the policy issues, given the scale of the increase in indebtedness from roughly 100% of GDP to 140%, and the fact that this dwarfs entirely the government's debt, of which we've heard so much in the context of this latest budget, are we not in a relatively serious situation here as a nation? How many years could we continue at the current rate of blowout without seeing structural consequences for our Trans-Tasman relationship for a start?
In the March quarter, our debt to GDP ratio rose by, I think it was about 5%. It's rising at a rate about 10% a year, although it's actually accelerated in the last 2 quarters.
It's appalling, isn't it?
Yeah. If we keep going like this, we'd be at 170% of GDP inside 3 years. And we're already using our credit card to pay our mortgage, you know what I mean? And frankly, the Australians will not let us do this for much longer. I mean, this is why you're seeing noises again, no doubt through the highest levels, of a single banking regulator.
Yeah.
APRA is nervous.
So why would that solve supplementary, why would that solve the problem? Is the problem not more fundamental, which is we don't make enough and sell enough, and we borrow too much to fund housing and consumption? Isn't that a very simple problem? And it's a different policy response other than putting more wallpaper over the crack, which is that we ought to direct more capital to investment and less to housing.
Yes, I think we need a structural change in our system of taxing, not just income but investment and consumption, so that we direct more investment to business and particularly the productive sectors rather than the consumptive and property sectors. We need factories and bright people with great intellectual capital. We do not need more batches and more extensions and flat screen TVs.
Fantastic. I'll hold the questions and Julie, Russell.
Thank you for your submission. I mean, I can only, agree with you that borrowing money from overseas to speculate on each other's houses is not a way to prosperity or a sustainable economy. And the net GDP debt figure is somewhere around 100% now, which I think is also, you can't just look at the gross figure, you need to look at the net figure, and the net figure is around 100%.
Yeah, that's right.
Of overseas debt, the international investment position. So it's quite extraordinary, and it's just growing rapidly.
Although the lenders would say any debt for them is real debt, there's no offset for their debt.
Yeah, and from their point of view, it's just a question of how long does their confidence last is essentially the question. The question I have is just about responses, and one of them I'm quite interested in is the capital adequacy stuff. I'm also particularly interested in the targeted capital adequacy ratio. I don't think we want a broad brush thing. We want to say, should we give the Reserve Bank the powers and the ability to target particular sectors, identify them as risks, asset bubble risks, and actually increase the capital ratios just for those targeted sectors? Housing is the obvious one. There may be others at other times. Rather than just kind of say we want to do it across the board, we want to target the capital adequacy ratio increases in those sectors.
Yeah, I'd be reluctant to have the Reserve Bank going in and having different capital adequacy ratios for different types of lending. There is one problem here. We are lending too much to housing. We already have a 15% regulatory top-up on Basel II for housing. Double it, triple it, whatever you want to do. You'd probably have to phase it in, because if you doubled it, it would